Hello, everyone. My name is Ryan Grady. I'm the investment advisor representative and vice president here at Paradigm Wealth, and we want to share with you our 2026 market outlook. Happy to do this on video, but of course, if you have any questions related to what you're seeing going on in the news, things are changing and evolving literally by the minute. So please do not hesitate to reach out. We will be doing so proactively if you are an existing client to review your plan, to update what's going on in your life, and again, how what's going on in the world today is impacting your portfolio and what we're doing to adjust and to plan and prepare accordingly. And if you're not a client and you have questions, you're interested in financial planning, please don't hesitate to reach out. We'd love to meet you and talk with you as well. So, with that being said, let's get into it. Let's go through it. What do we want to do here? First thing is a quick agenda. We're going to look back at 25. We're going to talk about some themes for 26. We're going to address the AI. Are we in a bubble? Obviously, a very big topic. We'll pull back, look at some things from a macro perspective. We got changes at the Fed, and of course, geopolitics. Disclaimers at the end to cover that. So 2025 recap, what did we see? Well, 2025 seems like forever ago, but it was a strong year. S&P up almost 18%. The story maintained the same as it has over the previous couple of years, which is tech led the way. Mag 7 stocks were the main drivers of returns. Believe it or not, inflation did come down by the numbers. Doesn't feel like it sometimes when you get your bills and you're paying stuff, but inflation did cool off a little bit. The economy resilient. We like to spend money, and we certainly kept doing that in 2025. Volatility was real. There was pullbacks. If you remember April with the tariff announcement and also different announcements from the Fed caused the market to have some volatility, but the takeaway is, as it typically always is a diversified long-term plan, not something where you're making emotional decisions based off of what you're seeing every day in the news, is going to almost always be the answer to those types of volatility things you see in the news. So again, very scary to see the market move and those types of things. But when you have a plan, when you have a well-diversified portfolio, that is the answer to that type of volatility. So looking ahead to 2026, looking ahead, we're in 2026, but now we look at 26. Let's see what we've seen so far. Well, one thing we want to talk about is certainly rate cuts. That has been a topic that we've always talked about. So the chart there on the left there looks at the top green line showing rate cuts when there is no recession that follows. And when that happens, we have seen historically pretty good returns, 18.2% on average. So anytime we see rate cuts from the Federal Reserve and there's no recession to follow, markets really, really enjoy that. However, if you see that bottom line, that shows cuts and then a recession to follow. And you're starting to hear some headlines and that ugly word recession pop back up. Well, when we do see rate cuts followed by a recession, 12 months forward, the markets typically don't do well, on average, negative 2.7 returns. But the middle line there shows all cuts across all economic situations, and the markets generally do well when there's a rate cut environment. So the story here is all rate cuts are not equal. I know a lot of times we talk and it seems like if there's going to be rate cuts, it's going to be a tailwind for the market. It depends what happens in the economy after. So top right, some good news here is the Mag 7, if we go back to 2024, they were the dominant driver of earnings when you looked at the S&P 500. So you take those seven companies compared to the other 493, and they were the main driver of returns. And you can see that significantly higher blue bar in Q1 of 2024, and you can see the actually negative for the rest of the S&P 500. But you extrapolate that out over the next couple years into 2024, and the projection is that that's going to level out, right, as earnings begin to increase for these other companies. So that type of breadth in the market is a positive thing where you have more people participating. That's a good thing. Bottom right is, again, when it comes to politics, our concern is how is it going to impact portfolios, the markets, the economy? Well, we're in a midterm election year, and historically speaking, that has not been good for the markets. Increased volatility during midterm election years, lower returns on average, and greater drawdowns on average in midterm election years. Why is that? Well, people are kind of sitting on the sidelines waiting to see if their team wins, and if they don't, they get scared, they get nervous, they sell. So you see a lot of uncertainty during these midterm election years, and that plays out in the market. Good news is we look ahead for 2026 and earnings are anticipated to continue to grow. Earnings are a very important indicator of future returns. When earnings are strong, that is a good sign. And right now, estimates are showing earnings increasing throughout the year in 2026. We talked about that those Mag 7 companies, tech leading the way in 25 and in the previous years as well. Well, that has been significant. And I'll focus the chart on the right here. You can see when it came to, the influence those companies had in the S&P 500, 40% when you look at earnings came from those top 10 companies. That's a lot of concentration in a small number of companies. So when you have that level of concentration, naturally that brings about some risks because the performance of those companies have such a profound impact, even when you're invested in the index, even when you're invested in the S&P, thinking you're diversified across 500 companies, those 7 to 10 companies really, really had an overweighted influence on the performance of that index. But these things have started to change. This chart is outdated, but still, this was through January 30th. And what you saw as we started 2026 was a rotation out of those tech companies and into things that have been unloved for a while. Energy, materials, consumer staples, right? It wasn't so much that those tech companies were not good investments anymore. It's just that they had done so well over the years. And those valuations got to a point where I think a lot of investors thought, hey, let me take some of my winnings off the table and rotate into some things that are cheap, that are affordable, that are at historically lower valuations and prices. Let me right, sell high, buy low. So I think you saw that rotation. Again, not so much a treatise on whether those tech companies are good investments or not, and more about just making an investment decision to rotate into um, cheaper investments that have been unloved over the recent times. Now you add what's going on in Iran with the price of oil, and obviously you're seeing some moves in that energy sector even more profound today. But this was beginning even before all that. And again, that rotation, that breadth in the market, that more asset classes participating in that's a good thing. This chart kind of speaks to that as well, right? And what these squiggly lines are really speaking to is they're comparing the S&P with the equal weight. So the S&P, as it stands, is market capitalized. So the bigger the company, the more influence they have. But when you treat all the companies the same, um, and you have a more similar experience, that again, that speaks to the breadth of the market, having more companies participating, and we've seen that, right? We're starting to see less of a concentration in just the top 10 companies, more participation from the other companies. That's a good thing. So now we talked about AI. Let's dive deeper. Are we in a bubble, right? Are we in a bubble? And should we be concerned? So this chart, very interesting. You look at the price return of the Nasdaq, the tech-heavy Nasdaq, right? And it compares that time in the late 90s, early 2000s where we were in a bubble. And what you see there is the returns from 1997 to 2000 were around 450%. So that looks very much like a bubble to me. Look now at the bottom line there, showing returns in the Nasdaq from 2023 on to 2025, October 25. Good returns, but not anything extraordinary like we saw back in 2000. I think this chart really does show it even more significantly. So now we compare on the left what we're seeing now, earnings and the price, right? So we're looking at earnings of these companies compared to the price, and there's a real close, tight parallel there, right? So these companies are earning money. They certainly are not what we saw back in 2000. These are companies that are making a lot of money and previously have had a ton of cash on hand. So there are some real numbers to justify those valuations. You look at the chart on the right, which now we're going back to 2000 and that dot-com bubble. What does that circle look like? It looks like a bubble because that's what it was. Earnings were much lower than what the valuations of these companies were showing. So you were paying a high price for companies that were not um, generating the earnings to really support those extremely high valuations. So again, when you look back, and that's kind of all we have sometimes to do is to look back at scenarios in the past and say and compare them. If we do that, it would not appear that the situation we're in now is a bubble, at least not compared to more recent historical bubbles that we've been through. And again, a big part of that is the cash flow these companies had. Um, Over the past couple of years, the Mag Seven, you look at the names Alphabet, Amazon, Apple, Broadcom, Meta, Microsoft, Nvidia, they have just been flush with cash, tons and tons of cash. So very, very healthy balance sheets for them. But now they've decided it's time to spend. And that has been a reason also investors have been like, okay, well, previously these companies have just been sitting on piles of cash. Now those companies are starting to take some of that free cash flow and pour it into future growth. And so now free cash flow has lowered. So if I'm an investor, it's not that they don't have cash, it's now they have less cash. Well, maybe that's a reason for concern because now you're saying, well, now I'm making a bet that these capital expenditures, the money they are investing in future growth, is it going to work? Are they going to develop technology that's going to revolutionize the industry? If so, great. It's a company I want to be in. If not, if those investments fall short, then the price has to come down, valuation has to come down, and that will impact obviously the stock price. So that's where we're at now. These companies have taken that cash flow that they've been so heavy, have had in such abundance amounts, and now they're putting it back into investments. How is that going to play out? One thing you may or may not hear a lot of talking about though. So we talked about these companies, and they're the fundamentals look strong, cash flow is strong. So again, that would speak to uh, positive news for the tech sector moving forward. What are some of the bigger challenges that maybe you are or not thinking of? Power. How are we going to power what's going to be needed for these types of AI advancements coming up? And you can see here the chart on the left, very interesting. Over the years since 2005, the energy consumption has kind of pretty much been level there. Looking ahead, the energy that is going to be needed to support the infrastructure for a lot of this AI technology jumps up about on a high end scenario about 25 to 30% more. Even a low end cement scenario is still going to be a significant amount more energy needed. You look at the chart on the right, that blue bar represents the power that will be needed over the next 4 or 5 years. Those light blue numbers are showing what we currently have available, and that number on the right, that bar, that gray bar, you may be able to or not be able to see, is showing the shortfall. It's a significant amount of energy that we have to find and create, and we're already dealing with an antiquated energy grid structure. So we're not coming into a great scenario. This chart shows the green is what exists in terms of data centers. The yellow is what needs to be created over the next couple of years to support, again, the growth that we're seeing. I'll draw your attention to this area here in Virginia by DC. It is the most concentrated area for these types of centers, these data centers. And right now, the power that they're anticipating needing over the next couple of years is shown here in this green line. The yellow bars is what's available. How are we solving that problem? How are we answering that problem to be able to supply the power that's going to be needed to support this, right? So again, we may have a scenario where companies' fundamentals are strong, they're making great, smart money investments to grow the company, but maybe there is an inability to support them through power, the necessary power, and that causes maybe a decline in the stock prices in the industry because of that. Something that we're keeping an eye on, something that certainly needs to be answered to quell some fears. All right, so now let's look at a macro view and geopolitics, all that fun stuff, and we'll look at the Federal Reserve. So Kevin Warsh, he'll be, we believe, starting in May. Um, he's probably the most responsible choice of all the candidates that were out there. In speaking with our chief investment officer, David Meyer, it was of his opinion that of all the candidates out there that this was the best choice for it in terms of somebody who is going to attempt to return the Federal Reserve to what it should be, which is a non-political, nonpartisan entity that makes the best decisions possible for the economy, right? Someone that's not going to be influenced um, easily. Now, that's a big ask when you have somebody like Donald Trump in office, who is certainly going to push him to cut rates. But we're hopeful that Kevin Warsh will be able to hold the fort and make the right decisions because it's the right decision, not because he's forced to. So certainly plans to shrink the Fed balance sheet, return to that core Fed mission, which is again inflation and jobs, right? Make sure that there's um, a healthy unemployment rate and make sure that inflation's under control. and he does have strong views on AI and its growth, right? So again, we think he's the right guy, the choice. He's going to be under a lot of pressure. Uh, he's going to have a very difficult situation on his hand, right? Currently, we have the war in Iran driving up oil prices, which is inflationary. Yet we also have very, as we'll see here in a second, we have alarming job numbers, right? Not a lot of jobs being posted, not a lot of hirings taking place. That would call for a rate cut to help bolster the economy. What's he going to do? He's kind of stuck between a rock and a hard place. So it'll be very interesting, and we certainly will be watching that. This chart is a lot going on in this chart, and I think I'm just going to sum it up by saying, boy, the anticipation for rate cuts and what we thought has just changed so much. I think we came into this year talking about four rate cuts. Now it's two. Now it's maybe not. It's all over the place. But that creates a challenging environment because rate cuts do impact the market, as we talked about earlier, right? Certainly, rate cuts followed by a recession or not, all those things that we had spoken about previously in this presentation that matter. So we keep an eye on that, but right now it is very difficult, especially with the unknowns going on in the Middle East of what the Federal Reserve will do as far as rate cuts moving forward. Talked about the labor market. Again, this goes back February 26th, so just about a month, 2 months ago, and the numbers were not very good. Job postings are down, and hiring rates are down, right? So I had heard something, it's not necessarily that we're seeing large amounts of layoffs, and we have seen that more recently, but it's just that nobody's hiring. And I'm sure anecdotally, if you have anybody, any young people in your family coming out of college or somebody looking for a new job, they could probably speak to that. Not easy right now to get hired. So we talk about the consumer a lot. The consumer drives the economy, right? I believe we're something around 2/3 of the economy is us going out and buying stuff on Amazon and spending money. So what the consumer is thinking and feeling and the health of the consumer is very, very important. So I'll draw your attention to what I think is the most important chart here on this, and that is the bottom right, and that is delinquencies, right? Something that we keep an eye on. So what you're noticing there is there's a big uptick in delinquencies, specifically around student loans. Um, you're seeing credit cards start to rise as well, auto loans and mortgages. Now, there is kind of an hierarchy there, right? So there is some logic to this in terms of, people you can't get kicked out of your house. You're going to pay your mortgage, right? So you're going to make sure that gets paid. Got to get to work. You got to get to and fro. You're going to pay your car loan. Credit cards, you're going to start to be like, all right, those are high interest. I got to at least pay the minimum. And then lastly, student loans, if something's got to go, it's going to be that. And I think that's what you're seeing. So the health of the consumer is as those debts start to weigh in them, they're just starting to say, I got to prioritize what needs to get paid and I got to let go what I can't. That could be a domino effect, right? So that is something we're keeping an eye on and certainly is concerning. A lot of talk about the US dollar and what that means. And I think this is just important to look at in terms of how it will impact investments, right? Where do opportunities arise when you are in a weakened dollar um, scenario? And typically that means attractive investments overseas, right? It does speak to the ability to find opportunities outside of the typical US large cap growth, US large cap value, right? It gives opportunities now to find good investments in international developed and emerging market investments. Tariffs was such a huge thing to talk about what seemed like 5 minutes ago, and now that war broke out, it's almost a forgotten topic, but they did happen. And you can see the spike in revenue for the US from those tariffs. So again, a lot of debate on whether the tariffs made sense, were good, were effective. These are just the numbers, right? And excuse me, a large amount of money has poured in from these tariffs. Now, that's just those numbers. Any auxiliary issues that resulted from these tariffs, relationships with other countries. Obviously, this is a quagmire and a lot that goes with it. It's not as simple as, hey, there was tariffs, we brought in revenue. But again, this was a big topic. What was going to happen? This is part of that data is that we did see as a country a large amount of revenue pour in. So that really is all I got for you in terms of just updating you guys on the market. I just want to thank you for spending the time joining me here today. And again, I can't stress enough the importance. We want to sit down, we want to talk, we want to touch base with you. Certainly, if you have any questions, and it's in between our regularly scheduled review meetings, give us a call, reach out to the office. Lauren, myself, Michelle, we are available for you because we want to make sure that you're comfortable knowing what's going on and how it impacts your plan, right? And on that note, something we also want to make sure we're doing is we're revisiting that plan. What is your plan? Are we on track? What do we need to do to make sure we continue to be on track? Are there any changes? Are there any updates? I don't believe there's any amount of time that is too much for us to talk. I love working with you guys. I love talking with you guys. So any frequency that would make you feel comfortable in terms of us communicating and giving you some comfortability around what's going on in the market, your investments, would love to spend some time doing that. So thank you again. Hope you're having a wonderful start to your 2026, and we will talk to you soon.